Let's talk about the difference between residential and commercial lending. And again, you're going to be using this strategy when you own rentals on the back end when it's time to refinance. In the previous video, we explained the difference between hard money lenders and private money lenders, which we're going to use when you buy a distressed property that needs rehab. But if you're going to keep it for a rental, then now you need to consider either residential or commercial lending for the long-term financing. So now, once you finish the rehab on the property, it's time to rent. Once you rent out the property, you need to refinance using either a residential or a commercial lender. Let's go over the details. Residential loan, that means that it's going to go under your personal name versus commercial. It's going to be under your entity. Therefore, if it's a residential loan, it's going to show in your credit report. You can have up to 10 residential loans in your credit. Commercial is unlimited. And the biggest difference between the two of them is that residential, it's going to be the lowest interest rate that you can get, 3 to 4% versus 4 to 6%. Obviously, the requirements are a little bit more stringent on the personal or residential loan. In this case, they're going to be asking for a 720 FICO score or above. They're going to ask you for 2 years of tax returns, W-2s, pay stubs, and they're going to give you up to 80% of the appraisal value in the loan. As for the commercial lending, the interest rates is going to be a little bit higher, 4 to 6%, and they're going to ask you for at least 25% equity on your existing property, and that it cash flows. Super important. And finally, they will also give you up to 80% of the appraisal value. Example, if the property appraised for $100,000, they're going to give you $80,000 on both scenarios.